Hello, this is Brad Rossley. Welcome to our halftime report on the economic and market review. Thanks to Frank Russell for providing us some slides that we can use to share with you a little bit of my commentary here for today. First thing I'd like to look at here is some economic indicators. And I'd like to point out to start with that the VIX, the VIX, is the top line. And it starts off by showing that it's at a very low rating, which means that it is a market with a lot of calm individual investors. There's very little anxiety out there. This number moves much higher when people are nervous. I tend to like it when people are a little bit nervous because I think the markets tend to climb what I call a wall of worry. So I'm a little bit concerned about the complacency that investors are showing right now. U.S. Treasury yields are very low, and they've been coming down again. The economy is not picking up, and the Federal Reserve is pumping money supply into the economy, which is keeping rates historically low. This is good for people getting a new house with a mortgage. It's terrible for seniors living on fixed income from CDs. Yield spreads are still pretty high. Yield spread is the difference between long-term and short-term bond. Home prices have been bouncing back in most areas. Again, this is very specific to your location, but we have seen a little bit of a bounce in home prices. Inflation, very, very low. There's no wage inflation whatsoever. A lot of prices are actually deflating in value, especially with technology. However, there is inflation in areas such as the cost of a gallon of gas. 5-6 years ago, it was $1.83. Now it's close to $4. So if you're spending most of your time, like I often do, carting my kids around to sporting events, the cost of gas is definitely a setback on the economy. Unemployment is a strange number. It is not a great number by itself because it does not accurately reflect the millions of people that are underemployed. Those are taking any job they can get. Well, they're off the doles or under the unemployment. They no longer fall into that calculation. Neither do all the people who have thrown up their hands and stopped looking for work altogether. Our nation's at the lowest percentage of workers in the nation's history. Fewer people are working today as a percentage than ever before. That is not a sign of economic growth and prosperity. We had another horrible sign of economic expansion when we had a contraction in the GDP, the gross domestic product, last quarter, down 2.9%. That's one of the worst quarters in history. I'm hoping it's just a blip on the radar. Maybe it was weather-induced, but that was horrible. If we have 2 quarters in a row of negative GDP, that's called a recession. I do expect things to improve the rest of the year, but not by as much as a lot of economists are believing at this point. Consumer sentiment is generally somewhat average. The glass is half full, the glass is half empty, depends on how you look at it. But overall, things have certainly slowly gotten a little better from where they were several years ago, so that's a good thing. How have you done as far as your investment returns? Well, that would depend on where your money is. There are multiple asset classes. There's U.S. stocks and international stocks, emerging markets, bonds, REITs, and commodities. Well, depending on where your money was will tell you how much money you've been making as a whole. For example, this year stocks have done very well. Bonds have not done quite as well, and commodities are just scratching out, basically breaking even. You go back to the 1-year numbers. I think those are really interesting picture. Stocks, U.S. domestic stocks in the light blue are up 25.2%, while bonds are in the orange and they're up 4.4%. If you had a portfolio that was 50% stock and 50% bond, you would have made approximately 15% in the last year, which is a pretty nice return. I'm expecting a decline. Why? Because it's normal. The typical decline over the last 30 years, 35 years, is 13.9%. From peak to trough during the year. The last couple of years, the worst we've seen is 5%. You have to go all the way back to the second quarter of 2012 to see a 16% drop in the market during the course of the year. Obviously, we're much higher now than we were back then. Expect it. Despite those drops in the middle of the year, the stock market's still up 28 of the last 34 years. So it's going to happen. Let's make sure we don't panic out. To conclude today, I was thinking about the World Cup and some research that I came across. There was a study about how soccer goalies behaved and performed under pressure. And I thought about how financial advisors perform with their clients under pressure. Very interesting. 286 penalty kicks in a professional soccer league during the season. At the professional level, penalty kicks are hit too fast for the goalie to actually make a reaction after the kick. They're too close, the ball's coming too hard. They have to pick a strategy somewhat randomly before knowing where the ball will be kicked. And yet goalies dove left or right 94% of the time. So they made a move. But what about the outcomes of the different strategies? Diving left, diving right. Well, they caught 30% of the time they caught the ball when they dove to their left. They caught 25% when they dove to their right. Yet they caught 60% more, nearly twice as many, when they stayed in the center. So here's the key question. Why did they dive? And what lesson can advisors learn from this? Staying in the center feels, and maybe more importantly, looks terribly indecisive. Goalies don't get criticized nearly as much when they dive for a ball and miss, even though they can't accurately predict which direction it will go in. If they miss while diving, it was a good try. If they miss while standing in the center, they look like an idiot. Well, client expectations put a lot of pressure on their advisors to do something, even if sticking to the plan is a sensible thing to do. So I want you to keep that in mind next time you call me or I send you out some communications that say, hey, listen, we're staying pat because this is what's prudent. There's a lot going on in the world, but we're specific to your plan and how your money's allocated is fitting with exactly the most prudent method we can come up with to get you the highest percentage of success. So think about that going forward. If you have any questions, please feel free to call me, 630-942-9007, or email me, brad@fortunefinancialgroup.com. Thanks so much for listening today. Let's hope the second half of the year is just as good as the first, if not better, for investments. Have a wonderful summer, and we'll be in touch.